The initial source of funds for your startup is your own money. This is called bootstrapping. You may also be able to secure a small business loan or raise capital from friends and family. When you're ready to raise a seed round of financing, which could be as much as $1 million, you'll typically look at angel investors. Finally, when you're ready to raise $3 million to $10 million in a Series A financing round, you'll typically turn to venture capital. According to Investopia, venture capital is financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. For startups without access to capital markets, venture capital is an essential source of money. Venture capital firms typically have a partnership structure. Limited partners provide money into the venture capital fund, and general partners make investment decisions and manage those investments. Limited partners can be high net worth individuals, corporations, endowments, pension funds, and even mutual funds. A typical VC fund has a 10-year life. Venture capital funds range in size from $25 million to over $1 billion. Typically, a venture fund that makes Series A venture investments needs to have $100 to $200 million in funds. Smaller funds are typically making seed stage investments. The average deal size in Series A is about $5 million per venture fund, and in a Series B, it's around $10 million. Series C and Series D investments average around $25 million. According to VentureBeat, in order to make 10 investments, the average venture capital firm reviews approximately 1,200 companies. These 1,200 come from network introductions, conferences, inbound inquiries, proactive efforts, portfolio company referrals, and seed investors. Of that 1,200, we find that approximately 500 lead to face-to-face meetings with someone on the investment team. So the math works out this way. A $200 million venture fund will make 20 to 25 investments over a 4 to 5 year period of time. Some of the companies will get follow-on investments, others will not. The venture firm will meet with an average of 4 companies per week and will only make 4 to 5 investments per year on average. I think the major takeaway for the entrepreneurs out there is don't get overly frustrated or discouraged if you have to meet with a lot of venture firms to get your deal funded. Definitely look at the requirements for getting funded and make sure that you meet them. But even if you're ready for venture capital and you are running an efficient process, it may still take a while and many meetings to get the necessary funding for your startup. A venture capital firm typically raises a new fund every 4 to 5 years. Unless you have a terrific idea, a very strong track record as an entrepreneur, and an established set of VC relationships, I think you should wait until you have a product and initial revenue before trying to raise money from venture capital. This is typically the Series A stage or your first institutional round of financing. Let's say you're raising a $10 million Series A round of funding from 2 venture capitalists. You will likely give away 20% of the company for that amount. Therefore, the pre-money valuation of the company would need to be $40 million. To command that valuation, the VC firm needs to believe that your company can be worth $500 million within the next several years. Ideally, they want to invest in companies that have the potential to have a $1 billion valuation at exit. That's how they make money for themselves and for their limited partners. Venture capitalists want to see an internal rate of return, or IRR, in excess of 30% for their fund, and a return on investment of at least 10x. Since some of the deals will lose all or part of the money, and some will break even, the VCs want to find the companies that will make the fund. In other words, a deal that would return $200 million in a $200 million fund. The center of gravity for venture investing is the San Francisco Bay Area, and the center of gravity for venture funds is Sand Hill Road in Menlo Park, California. Your chances of raising venture capital are greatly enhanced if you locate your company in the San Francisco Bay Area. However, most of the Bay Area VCs do make investments outside of Silicon Valley, and there are also many venture funds that do not reside in Silicon Valley. The right venture fund for you will have a venture partner that has a deep interest and passion for you and your company and has domain expertise and technical knowledge about your product market space. These are called smart money investors. You find them by looking at what specific past investments have been made by the general partners in the fund. They will also have a fund size that can support multiple rounds of investment in your company. You will also want someone who will be helpful on your board of directors because they will likely get a board seat.